if there is a soft landing scenario. So I want to in fact toss this question to our guest Ajay Srivastava, who's joining in of Dimensions Consulting. Ajay, you know, this is something that is right down your alley. I think for the last maybe 3 or 4 months, you've been saying that equities is not the place to be. There are other asset classes, alternate asset classes that you should look at. Does gold top your list?
Of course it does. You already gave it all the statistics possible. Your mother told you, your grandmother told you, and they were very wise investors at this point of time. And it's brilliant that you put up this analysis because it tells people that there is more to investment than the stock market. There's more to investment than the headlines. Simple, straightforward investment strategy, gold. And the reason gold is good is two things are happening. Supply doesn't go up dramatically, but all the central banks, whether it's India, whether it's China, whether it's Europe now, they all are stocking up gold. So, you know, not only there is a consumer demand, there is a huge demand from central banks to shore up the gold reserve. And quite obviously, as arithmetic goes, when the reserves go up, the proportion of gold they need to maintain has to also go up. And therefore, they need to buy gold. So gold will remain an absolute gold standard for investment for the three reasons. Central banks want it. It's most liquid of the all. And when the market hits the real bad patch, it's gold which counts in the end. So I would certainly say gold will remain, should remain a decent part of, I'm not saying put everything in gold, but should remain a decent part of a portfolio. And I think I heard you saying jewelry. Don't even count that as an investment. Man, that's an expense. Book it.
Sovereign gold bonds. Yeah, I know what you're getting to.
Ajay, so exactly that point. And just to complete that loop on gold, what is the best way to own it? I mean, gold, in what form? Sovereign bonds or something else?
ETF.
I think I would say sovereign gold bonds is good, but I would still prefer physical gold to hold with us because government is government at the end of the day. Physical gold I would like to keep, and you know, so some of the coins which are coming up in the Hong Kong coin and the other stuff is a premium to the market. You can't get them if you want a large quantity. So I would say bars, physical gold in bars and coins would be the right way to do it. Put part of it in the 2.5% because that's subject to government can do what it wants, the rate what it wants. So physical gold over paper gold any day.
Under the mattress, basically.
We can try the coins. The bars will be a little too expensive. Nimesh, but you've got another piece for us.
So, you know, I've looked at the earnings, what to expect in Q3. We've already seen some IT companies reporting, and the broad line is that the top line is good, but there is a hit on the margin. So, looks like that's going to be the big theme in the Q3 earnings across the board. So, the big picture is expect a muted earnings. So, no big surprises there. Post Q3 earnings, you can expect a 4 to 6% EPS cut for FY23. That's the consensus across most of the brokerages. Now, where the earnings cut will come in, it will come in energy, materials, and consumer discretionary. Whereas you will see a positive surprise in the financials, but to some extent, that's in the price. It's going to be margin pressure across the sector. That's the overall feedback from most of the brokerages. Now, I've looked at the sectoral trends as well, to what to expect in various sectors. I'll start with autos first. In autos, expect a bit of a gross margin improvement because of the cooling commodity prices. So that's something for autos. For capital goods, the order book will be most important to track in Q3. For cement, that's going to be interesting because for cement, the expectation is there is going to be some improvement quarter on quarter in terms of EBITDA per ton. So that's something to watch out for as far as cement is concerned. For discretionary and retail, the commentary on demand slowdown will be very important to track in terms of earnings. For financials, that's going to be very important. You're going to see a very strong credit growth plus the NIM expansion as well. So that's going to be a double benefit for the financial sector. For pharma, a decent sort of domestic demand. And for telecom, a very small ARPU growth is what most of the brokerages are expecting. I'm also looking at some of the individual stocks. There was a Citi note on expectations from Q3, and they've put out some stocks which will be positive and negative surprises. In terms of positive surprises in Q3, Ambuja Cement, SBI Life, Ashok Leyland, L&T and Cipla. These are the stocks which can surprise positively in terms of earnings. And in terms of negative surprises, Tata Steel, TVS Motors, Page Industries, Adani Port, United Spirits. These are the few stocks where Citi expects a negative surprise in the quarterly earnings. So the net, the big picture is expect a 3 to 4% or 4 to 6% EPS cut in FY23 post Q3 earnings.
Okay. All right.
Okay. All right. Thanks for that, Nimesh. Well, Ajay, this market has been moving higher, and we have been the big outperformer because we are going to get the best earnings growth. That suddenly seems to be in a bit of doubt, right? Because earlier we were talking about mid-teens growth for 2 years, easy peasy. Suddenly that's going to be in doubt, right? What's your take on that?
Well, you are simple. If you have inflation at 20% again, you'll grow at 22%. It's as simple as that. So I think people who mistook inflationary growth, which has happened in the bank portfolio as well, to be the real growth, need to do the calculation at the end of the day that how much of it has come from the inflation and how much it has come from the genuine industrial growth. You can't have a thesis that India will grow at 6% and this 6 months will grow at 4.5%, but banks will grow at 18%. Banks can grow at 18% only, and margin can grow 18% if inflation is above 10%. And if the target of inflation is 5%, then there is no way the economy and the banking system, for instance, and the people under the bank can grow by more than 10%. It's arithmetical. It's nothing exotic about it. Yes, there will be outliers. There will be outlier companies, and that's the beauty of every market, and you get paid for it, is to identify those outliers who will restructure the industry, who will score over the people, etc. The problem here is not the margin. The problem here is not the expectation. The problem is we're starting off a base of over-enthusiastic mass of retail investors who are pumping in money in the market. Now, their hope is somebody's going to buy on a P expansion mode because everybody knows, you can't go much beyond the economy, maybe double the economy. If you double the economy, it's 12% growth. But your Ps are running at 30s and 40s and 50s and thereabouts. Now, how does that portfolio make it grow? That's the challenge here. So your challenge in India is large bunch of retail investors hoping against hope that their returns will exceed the fixed income, which it is not happening. Now, when will they realize it? We don't know. But right now, the mood is very simple. Pick your companies very carefully. Are you feeling lucky on the day you pick your company? Please focus on them. Don't look at astrology chart. I didn't mean lucky that way. Analyze them deep to see that these companies can grow well in spite of a low growth economy trajectory. And, and we have to have the honesty to look at the fact that 80 crore Indians as a population need food grains to survive. So Indian economy is really worth about 20-30 crore people. Headlines saying Mercedes-Benz sells highest cars ever in the history does not make the economy. So therefore, prudent selection, I think, is the answer here. And, you got to be realistic as to what you're doing. And if you bought at high Ps, well, you can average and keep averaging.
Okay, I thought you were going to end on an optimistic note. That's a rather somber note that you're ending the discussion on. It's the weekend. Come on, you can lighten up a little bit, Ajay.
No, I can light you up by telling you the beautiful thing is that please, and I've been saying this, spend your money. That's more important. Spend it on your parents, spend it on yourself, spend it on your wife, be in the good books of everybody around. Because in this economy, at inflation at 7-8%, you're really not saving anything. You're worthwhile buying stuff and enjoying it. And that's been a mantra saying, forget all this investment. It gives you grief at the end of the day, right? You put your money, save, put it there, and don't make a return. Can you imagine?
Right.
It's bad.
Ajay, thank you for that wisdom.
You're welcome.
Much needed now, especially post-COVID, right? That's how people have changed. Just go out there and have fun. Thanks a lot for joining in. But now we're going to start talking about the budget. And then once again, all the chatter will be on capital gains tax. So Prashant has put some data together. Prashant, is it all noise?
I mean, on some aspects,